Total return swap. Okay, I know it sounds super complicated, right? It's one of those terms you hear on financial news and not just here and there. But what if I told you that underneath all that jargon, it's really just a simple bet? Stick with me because we are going to break this whole thing down. Yep, just think about that for a second. What if you could get all the benefits or the risk of market's performance without ever actually having to own the thing itself? Well, that's the real cool idea we are going to unpack today. To really get a hand on this, we are just going to throw all the Wall Street speak off the window. Instead, we are starting with something we can all understand, a simple bet between friends. Trust me, this little story is the key to the whole thing. Okay? So picture this. You and a friend decide to make a wager. Let's say 10 lakh rupees. Now, this isn't the real money that you are exchanging, not yet. Anyway, it's just the amount your bet is based on. You both agree this bet is going to run for a year, and here are the terms of the deal. You, as a party A, agree to pay your friend whatever the S&P 500 market index returns for the year. Meanwhile, your friend, party B, promises to pay you a nice steady fixed return of 5%, like interest. So you have the risky variable side, and your friend has the safe predictable side. Here's the absolute most important part. At the end of the year, nobody is handing you 10 lakh. That would be crazy. Instead, you just calculate what each of you owe, and whoever owes more just pays the difference. It's a clever little shortcut called netting, and it makes everything so much easier. Alright, let's play this out. For our first scenario, let's imagine the stock market has an absolutely fantastic year. Everything's going up. So the year ends and the results are in. The S&P just crushed in, jumped up by a huge 15%. Based, if you are on your deal, what happens now? Let's do the math. Okay, let's break down. Who owes what? First, your side of the bet. You promise to pay the market's return, and 15% of 10 lakh is 1,50,000. Now for your friend's side, they owe you that fixed 5%, which works out 55,000. Simple enough, right? Now we just settle up, we take the bigger number, the 1,50,000 that you owe, and we subtract the smaller amount, 55,000, your friend owes you. And the final difference is 95,000 rupees. And there it is. You write a check to your friend for 95,000 rupees. Your friend took the riskier side of the bet, betting on the market, and in a great year like this one, it totally paid off. He won this round. Okay, that was a happy path. But what happens when the things go the other way? Let's run a second scenario where the market doesn't just do poorly, it crashes. This time, it was a terrible year for stocks. The S&P 500 didn't go up 15%, it went down by 15%. And now your friend's bet on the market, well, it's looking like a really bad one. Okay, now this is where things get really interesting and honestly a little weird. It's not what you expect. This is the part that usually confuses people. So let's walk through it nice and slowly. You ready? Alright, check this out. First thing, the market went down by 15%. So your friend who took that side of the deal is now responsible for covering that loss. That negative 15% actually flips and becomes a payment of 1,50,000 that he owes you. And that's not all. On top of that, your friend still owes you that original fixed payment of 55,000 rupees. So notice what happens here. We are not subtracting this time. Your friend has two separate things they owe you. They have to cover the big market loss and they have to make that smaller fixed payment. So we add those two obligations together. 1,50,000 plus 55,000 gives us a grand total of 2,05,000. That's the final result. Your friend has to pay you a whooping 2,05,000. By taking that safe, steady side of bet, you are totally protected from the crash and actually came out way ahead. This time, you definitely won. So I'm guessing there's a big question in your mind right now. Hold on. Why did we subtract when the market went up, but we added when the market went down? That feels weird. This is the most important piece of the puzzle. So let's nail down the logic. Here's the simplest way to think about it. When the market went up, both of you had a gain on paper. You were just subtracting to see those gain was bigger. But when the market went down, it was totally different story. Your friend didn't just have a smaller gain, they had a loss they had to cover. Plus, they still owed you that fixed payment. It's two different debts getting piled on top of each other. So, they have to be added up. You followed a friendly bet. You have seen how the math works in good market and a bad one. And you totally get the logic. Now it's time to connect all this back to that complicated name we started with. There it is. That's the secret. This whole bet we just mapped out with you and your friend, the market return and the fixed payment. That's a total return swap. That's all it is. You are swapping the total return of the stock market for the total return of a fixed rate. See, it's not some financial wizardry. As its core, it's just an agreement. It's two people agreeing to exchange the performance of two different things. You just completely understood a major financial instrument that stumps a lot of people. If you forget everything else we talked about today, just try to remember this next part. We have boiled this whole big idea down into one single simple sentence. Here it is. A total return swap is just a bet between fixed interest versus market performance, and it's settled by paying the difference. That's it. That's the whole game. Now you know the secret. Once you start to see these big, scary financial products for what they really are, a lot of times just simple agreements or bets, the whole world of finance starts to seem a lot less intimidating. It makes you wonder, right? What other complicated things are just simple ideas in a fancy suit? Thank you.